Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three surging top ranked, so those are Zacks Rank number one strong buy stocks to consider for longer term upside. And the three of those stocks are Textron, which trades the ticker TXT, Nextracker, which trades in the ticker NXT, and AppLovin. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into the three stocks, I quickly just want to go over the market since I'm recording this on Thursday afternoon. The S&P 500 and the Nasdaq were up again at new all-time highs. Jay Powell and the Fed on Wednesday held their core interest rate at the same level it's been for a while now, but the bulls still got something to celebrate when they signaled that three more interest rate cuts, or the first three interest rate cuts, are still going to be on the table in 2024. So Wall Street had already been very convinced for a long time that the central bank would officially cut rates at some point in 2024. They were starting to think that September would maybe be the first time, but now Wall Street's a bit more upbeat that we could have a June or July cut, which would take some of the politics out of the equation as well. Still, the 10-year U.S. Treasury remains somewhat unchanged yesterday. It's around 4.27, 4.3%, which factors in that higher for longer note. But all the bulls needed on Wednesday to send the market to new all-time highs was confirmation that rate cuts were still going to happen in 2024, despite that lingering inflation. So now it's possible that after we surge to new highs over the last several days, that maybe we could see some chop around or a pullback to some 21-day or 50-day moving averages. But then the next big thing on the horizon, even though it's several weeks away at this point, would be the start of Q1 earnings season, which, as I'm looking at now, based on our most recent Zacks data, looks strong again. So S&P 500 earnings for the first quarter are expected to be up about 2.2% on 3.5% higher revenues. This followed a strong fourth quarter of 6.4% growth and 3.4% higher revenue. So a solid quarter. And then looking ahead to the rest of 2024 looks even better. We're calling for about 9% growth in Q2, 7% growth in Q3, and then 12% growth in Q4. Those estimates pretty much always come down as you get closer to those periods, but overall, really strong outlook for 2024 and 2025 based on the most recent Zacks data. And what's also important is that the tech stocks that are driving a lot of this big market rebound are, as we all know, showing real earnings growth. So the evolution of 2024 earnings for the tech sector has been really impressive. So that's another bullish sign heading into the first quarter. So as I said, after the Fed or the Wall Street got the go ahead for rate cuts at some point in 2024, 3 rate cuts to be exact, that the next big thing will be to see that the earnings picture can continue to hold up and grow despite lingering inflation and worries about an economic slowdown. So with that in mind, we're going to take a look at the first of our 3 stocks that are all Zacks Rank number one strong buy stocks that are surging at the moment. And the first of those is Textron, which trades in the ticker TXT. Textron is an aerospace and defense industry standout. It also operates multiple more commercial segments. Its Arctic Cat unit is a leader in small off-road vehicle space. Cessna and Beechcraft are private aviation powerhouses. Textron Systems then is best known for innovative defense and government technology services. And Howe is then a leader in advanced robotic land vehicles. Then its Bell segment has got a lot of attention recently because it landed a potentially massive U.S. Army contract in late 2022 to make its next generation helicopters. The contract could be worth up to $80 billion over the long run based on multiple reports. So it has a wide range of both defense contracts and, as I said, commercial segments with the Cessna and Arctic Cat and Beechcraft. So lots of different segments of this aerospace and defense company. Its earnings outlook for 2024 and 2025 have continued to improve, and this all helps it land that Zacks Rank number one strong buy. And then in terms of revenue growth, we're calling for about 7% growth in 2024, and then another 7% growth in 2025. And as I said, that's first sales growth. And this would come after 3 straight years of top-line expansion and mark an improvement over all 3 of those years, with the highest being 6% growth last year, and would mark its strongest. So that would be 6 straight years of top line growth, which would mark its strongest in a very, very long time. So that's a good sign. And then its adjusted earnings are projected to climb by 12% in 2024 and then another 11% in 2025. So strong growth. And then its overall earnings outlook has continued to improve over the last several months. And it's after its most recent earnings results, its outlook for 2024 is up 9%, with 2025 up 6%. So solid growth. And as I said, these upward earnings revisions started actually in the back half of the early part of 2023 and have continued to just surge. So as I said, that helps it land a Zacks Rank number 1 strong buy. Overall, TXT stock has outclimbed the broader Zacks aerospace sector over the last 20 years. It's up about 260% versus 190%, and it's blown away that group during the last 5 years and the last 10 years, with it up about 150% in the last decade. And Textron broke out of a key trading range in January following another blowout quarter to reach record highs. It's now up 42% in the last 12 months and 20% year to date. It hit new highs of over $96 per share on Thursday afternoon as I'm recording this. So it is maybe a little overextended in terms of its technical levels. It's a bit overheated in terms of RSI levels, and it's trading solidly above its 21-day and 21-week moving averages. So there could be a little bit more of a pullback here, but if we look at its outlook and its valuation levels, there could still be a far more room to run if you're a longer-term investor. So valuation-wise, it's trading at a nearly 30% discount to its 10-year highs and 25% below its industry at 14.8 times forward 12-month earnings. And then on top of that, some investors, if you're trying to diversify and have an aerospace and defense stock, and you're conscious of the actual price of the stock, it's trading, as I said, about $96, whereas some of its peers, Lockheed Martin, Northrop Grumman, are trading well over $400 per share. So that's a little added bonus there if you're worried about the actual stock price itself. And the next stock on our list is Nextracker, which also, as I said, lands a Zacks Rank number 1 strong buy, driven by impressive upward earnings revisions over the last year and a big post-blowout beat and raise revisions after its January 31st report. So the stock has soared after this report. It has, though, however, cooled off a bit recently, so investors could potentially get in an attractive entry point. So overall, the company is a leading player in the solar tracker segment. Its integrated solar trackers and software solutions are used at a utility scale and ground-mounted distribution projects across 30 countries. Nextracker and the wider solar tracker industry are vital cogs in the solar space because they move and reposition the solar panels themselves and the modules throughout the day to actually make sure that they're always facing the sun, because if not, they become far less useful. Nextracker's technologies aim to increase energy production while helping reduce costs in significant plant return on investment. So they're just trying to help have these solar farms produce more energy, better return on investment. That's their goal. That's the wider goal of the solar tracker industry, which Nextracker is one of the key players. The solar tracker maker's earnings and revenue growth outlook is highly impressive, and its valuation is really solid despite the fact that it's climbed over 90% since its early February 2023 IPO, while the wider solar industry has tumbled. On top of that, Wall Street's really high in the stock. 20 of the 22 brokerage recommendations that Zacks has are strong buys. And as we said, the company has bucked a lot of the recent trends in the solar industry. It's posted 36% year-over-year revenue growth in Q3, which was that period that I said it reported on January 31st. And it recently reported that quarter, as I said, the recently reported quarter marked the 4th consecutive period of double-digit growth, which drove profits as well. The firm posted a GAAP net income of $128 million and $710 million in revenue, so strong figures there. And then its adjusted earnings crushed our estimate by 96% last quarter for its 3rd straight huge beat. The company also closed last quarter with a record backlog, which was significantly exceeding $3 billion. It's expanding in the U.S. And around other regions such as India, the Middle East, and Africa. Looking ahead, our estimates are calling for the company to post 29% revenue growth in 2024, which is the current year it's in, to hit $2.45 billion and then climb another 17% next year. and its adjusted earnings are projected to skyrocket from 24 cents per share last year all the way up to $2.65 per share this year, and then climb another 22% next year. Its earnings outlook has gone pretty much straight up since it went public, including a lot of impressive jumps for 2025, which is next year recently. So that's a great sign. So as we touch on up top, the stock's up over 90% since its IPO versus the solar industry's tumble. The last time we looked, it was down around 50% during that stretch. The stock's up 24% year to date, though it has moved sideways since that big post-earnings release pop, with it down around 6% from its highs. So you possibly get in at a nicer entry point. It's currently hovering right around its 21-day moving average and at neutral RSI levels after being super overheated at the end of January and early February. The stock's also trading at a 21% discount to its highs at 22.9 times forward 12-month earnings, which is also slightly below the Zacks solar industry despite that huge outperformance. So overall, the solar industry has suffered through a rough stretch, even though Nextracker has been able to perform really well. But interest rates have peaked, and the Fed is, as I said, we're going to start cutting interest rates in the back half of this year. So it might be time to finally start looking into some of these solar stocks, with Nextracker being a name to certainly consider. And the last stock up today is AppLovin Corporation. AppLovin trades on ticker APP, APP, and its shares have soared 410% over the last 12 months to blow away NVIDIA and many other tech stocks. And as is the case with all of these stocks, it's currently a Zacks Rank #1 strong buy. So the company designs tools to help app developers improve marketing, revenue generation, other critical aspects of the app business to help drive profitability in both the near term and long term. The firm plays a key role in the app ecosystem with end-to-end software solutions that aim to optimize monetization through various products and solutions. Its products are designed to help companies and app developers acquire and keep their ideal users and then increase value across the customer lifecycle. It's a big, important business in the wild world of apps. I don't know if anyone ever goes through the App Store or anything like that. There are just countless apps. So a company like this that's helping you retain users and generate more money from them over the life cycle of them using your app is really important in a wild west of the app world. AppLovin began gaining steam recently through new advancements in AI and machine learning. The company's new AI engine dubbed Axon 2.0 is generating impressive results. The company said it helped it post record software, platform revenue, high margins, and ultimately will help it post robust free cash flow. So the company's really expecting to grow its presence in the app business, including its ability to help clients gain exposure in the connected TV landscape, which is another kind of thing we don't really think of when you think of apps. You think of more on your phone, but then all of the streaming devices are also apps. So that's another kind of growth runway for AppLovin. Its enhanced offerings are leading to better return on investments for its customers, and then should lead to further market expansion for AppLovin. So looking ahead to our growth estimates, we're calling for 23% revenue growth this year to get up to about $4 billion from $3.3 billion last year, and then another 10% growth next year. And then on the bottom line, we're calling for 153% expansion in 2024, and then 22% growth next year. So big bottom line growth as well. And then in terms of revenue growth, this came after the company posted 17% growth last year. So solid growth for AppLovin. And then over the last 3 quarters, it's crushed our bottom line estimates. And since its most recent report, its earnings revisions have soared. It's up 57% for 2024's consensus earning estimate and 77% for 2025. This is why Wall Street's loving the stock and everyone's jumping in. Its shares have skyrocketed 410%, as I mentioned up top, over the last 12 months to crush NVIDIA, which is up 250%. This includes an 80% run in 2024 alone. Yet, despite that, the stock is still trading nearly 25% below its November 2021 records, And we should note that it went public in April of 2021. So not the best time to go public since tech stocks peaked back in November of 2021. So it's still trading 25% below its highs, even though it's been on a massive surge over the last year. It is trading maybe at a little bit overheated levels at the moment, near overbought RSI levels and trading solidly above its 21-day moving average. It hit new highs once again as I'm recording this on Thursday afternoon. But if we look at its valuation, it's trading at 26.9 times forward 12-month earnings, which is 45% value compared to its own year-long median and roughly matches the tech sector despite this massive outperformance of the last year. In its portfolio of products and solutions are vital in the highly competitive world of apps, where, as I said, countless companies are competing for awareness and screen time and profitable success in our smartphone and app obsessed world. So that's a good business to be in. And as I said, or at least alluded to, Wall Street's really high in the stock. So 11 of the 16 brokerage recommendations that Zacks has for AppLovin are sitting at strong buys. So AppLovin and then all three of the stocks we talked about today overall are certainly worth considering, as there's Zacks Rank number one strong buys that are operating in key segments over the long term. And even though they're surging to new highs recently, if you're a longer term investor, there's still some upside left for all three of these stocks. So that does it for today's episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.